Welcome, Ifa. You may sit. Thank you. Ifa, as a Chief Financial Officer, I am deeply concerned about this substantial notice of additional tax assessment and penalty issued against our retail operating entity. These situations present a massive ethical dilemma for us. As a multinational business, how do we ethically balance our fiduciary duty to maximize shareholder return through proactive tax planning against our moral obligations to comply fully with the tax law of Malaysia and contribute fairly to public revenue?
You are completely right, TAHSA. Let's trace the background facts of our case, which is Ketua Pengarah Hasil Dalam Negeri versus Watson Personal Care Store Holding Limited. The core of the dispute lies in cross-border payment made by our local operational to our overseas holding company. These payments were classified as management fees, regional technical support fees, and IT infrastructure service charges. The IRBM audited this transaction and disallowed our local tax deduction, asserting they failed to satisfy the wholly and exclusively tax under Section 33(1) of the Income Tax Act 1967, and additionally, claimed some payments should have been subjected to withholding tax.
This impact multiply stakeholder. If corporate group aggressively shift profits out of Malaysia via artificial management fee, the Malaysian government loses critical revenue means for infrastructure, education and healthcare, harming society as a whole. Conversely, if a tax authority issue arbitrary or overly aggressive tax assessment without looking at true business realities, it disadvantages corporate taxpayer and compromises the fairness embedded within our self-assessment system.
Exactly. The fundamental role of the IRBM here is to safeguard the domestic tax base, enforce strict compliance with the Income Tax Act 1967, and eliminate transfer pricing manipulation that artificially erode the corporate tax yield in Malaysia.
Good day, Mia. As the senior tax auditor from IRBM, let me lay out the major tax issue dispute in this audit. The primary issue is deductibility under Section 33, Subsection 1, which is did Watson Malaysia prove that these cross-border payments were wholly and exclusively incurred in the production of local gross income. And the second issue is related to the Section 140A and the transfer pricing rules, which is were this control related party service price at arm's length. And lastly, we like to determine if these regional payments constitute technical fees or royalty, and making them subject to the withholding tax under Section 109B.
Okay, from an audit and compliance perspective, these issues are exceptionally significant. Cross-border related party expense represent one of the highest risk areas in international corporate taxation. This case signals to all corporate taxpayers that the IRBM is no longer accepting broad, unverified service agreements at face value. Taxpayers must demonstrate clear economic substance rather than just rely on formal legal documentation.
Exactly, Mia. When reviewing this transaction, we look closely for potential indicators of unethical behavior of tax negligence. Shifting massive profits via ambiguous management fees without verifiable documentation such as profit shifting or tax avoidance motivation. And the correct ethical professional action is required by law under Section 82 is to ensure complete transparency, which is maintaining the transfer pricing documentation, rigorous timesheets, and the cost allocation breakdowns to substantiate every single dollar claim.
Let's examine the arguments presented by the taxpayer during the appeal process. Watsons firstly argued that these management and regional IT fees were fundamental to sustaining local retail operations. They asserted that as a local subsidiary of a major multinational brand, their regional competitiveness, supply chain efficiency, and digital point of sale system depend heavily on centralized infrastructure provided by the foreign holding group. Thus, they argue that these expenses directly drove local revenue creation and were fully deductible under Section 33, Subsection 1.
Conversely, look at the argument presented by the IRBM in defending its position. The revenue argued that Watson Malaysia failed to satisfy the essential burden of proof. The IRBM highlighted that the taxpayer could not produce the contemporaneous evidence, such as task log, project timeliness, specific employee records, or a clear commercial justification for the cost-sharing formula. Without this, The IRBM argued that the expenses were not proved to be wholly and exclusively incurred for local income production, rendering them non-deductible or recharacterizable under Section 140A.
When we evaluate which party had the stronger legal argument, the legal balance strong favors the IRBM. Under Schedule 5 of the Income Tax Act 1967, the statutory burden of proof rests entirely on the taxpayer to demonstrate that an assessment is excessive or incorrect, because Watson's lack contemporaneous detailed transaction records and a granular cost-benefit breakdown at the time of the audit, they could not legally discharge this statutory burden, giving the IRBM a much stronger case.
Hello everyone. Hi.
Good day, Ms. TAHSA.
In explaining the court's decision, the High Court reversed that earlier findings of the Special Commissioner of Income Tax, SCIT. The High Court ruled in favor of the IRBM, holding that the management and service fee were not deductible under Section 33, Sub 1, due to an absolute lack of contemporaneous proof showing that actual services were rendered and that a direct economic benefit was received by the Malaysian operating entity.
Analyzing the legal principle applied by the court, the judiciary firmly emphasized the doctrine of sustained overform. A formal written intra-group contract or service agreement alone does not justify a tax deduction. There must be comprehensive empirical evidence proving that service were physically performed, commercially necessary, and carry a clear, undeniable nexus to the generation of the taxpayer's gross income under Section 33, Sub 1.
Critically evaluating this, the core judgment is completely consistent with the core objective of the Malaysian tax law. The main objective of the Income Tax Act 1997 is to collect national revenue equitably and prevent erosions of the domestic tax base through artificial cross-border shifting. By demanding high evidentiary standard for intra-group payment, the judiciary protects the economic interests of the country while ensuring a fair playing field for all domestic enterprises.
Good morning, everyone.
Good morning.
Okay, let's start. Looking forward to the implication on tax audit practices in Malaysia are profound, and the IRBM will continue to instantly audit management fees and cross-border intra-group cost allocation. In this case, solidifies our audit methodology. If a company cannot produce contemporaneous high-quality transfer pricing documentation right at the start of an audit, adjustment and heavily penalty will be strictly applied under Section 140A and Section 113.
To protect corporate groups from future tax dispute, we must implement clear compliance strategy. First, we must maintain robust, comprehensive record keeping, preparing our transfer pricing documentation annually before filing our tax return. Second, we must document clear, measurable service indicators, maintaining detailed itemized monthly project description, timesheet of regional personnel, and explicit evidence of local business benefit.
Furthermore, embedding professional ethics and strong tax governance within the accounting profession is essential. Tax professionals have a profound responsibility to guide corporate boards with total integrity. Ethical tax governance means ensuring that corporate tax planning aligns honestly with genuine economic substance, rather than relying on aggressive legal manipulation to hide profits.
Let's conclude by reflecting on the consequences of non-compliance. In the short term, non-compliance triggers devastating financial consequences, including large cash flow drains from tax penalty under Section 113, Subsections 2, immediate compounding interest, and massive legal defense costs. In the long term, public tax litigations causes severe reputational damage, completely eroding consumer goodwill, brand equity, and public trust. Ethical corporate tax governance is just not a regulatory obligation, it is fundamental pillar of the sustainable business.